Oh, that's all right. I'll try and write on this thing. Or maybe I'll. Okay, so we're going to pick up where we left off last class, which is talking about inventory and how do you deal with your journal entries to record cost of goods sold. So in last class we said, well, you know, if you were following a perpetual system, every single time you made a sale, you would also record which item you sold and how much it cost you. And it would be very easy. You'd say, okay, well, I, you know, sold this purse. I know exactly which one it is, and this is how much it cost me when I originally bought it. But that sort of record keeping is incredibly intensive, right? You need to know exactly which item had which cost, and it could be potentially a burden that you can't possibly deal with every single item and every single cost. So what we do instead is we sort of look at the end, we take stock, and we say, well, this is what we had at the beginning, this is what we have at the end, and here's how much it must have cost. But even if we do that, we still need to deal with the fact that costs for products may change over the period of time in which we purchase them. So think about it this way, okay? You have a bunch of products available for sale during the period. Now, in January, the products that you have on hand are the ones that you're selling, and then maybe you buy some more in February, and then you sell those in March, and then you buy some more in April, and you sell those, you know, so there's some sort of normal sequential way of thinking about it. But from an accounting perspective, none of that really matters. You start at the beginning of the year with a certain amount of products on hand. Over the entire year, you make purchases. At the end of the year, you have a different number of products on hand, and you assume that some of those were sold. It doesn't matter whether you technically sold any one specific item, okay? What matters is what accounting assumptions we make in order to record our cost of goods sold, okay? So let's say we had 100 units at the beginning of the period, and we didn't make any purchases throughout the year, okay? At the end of the year, we have 50 units. How many units have we sold? Okay, nobody has any problems figuring that out, right? We've had 100, we have 50 left, we must have sold 50. Now, what happens instead if we had 100 at the beginning of the year, we bought another 100 in June, and over the entire year, okay, we sold 150 units. Did we sell the units that we had at the beginning of the year? Did we sell the units that we bought in the middle of the year, or a combination of the two? Well, definitely a combination of the two, because we didn't have enough. If we sold 150 units, we only had 100 on hand or 100 purchased. But did we first sell the first 100 and then sell the next 50? We don't know that. Maybe we did, maybe we didn't. It doesn't matter from an accounting perspective. We just need to make some sort of assumption about which units we sold. Now, let's say we sold 100 units in March. Well, then you know logically you had to have sold the ones that you started with since you didn't buy the next ones until June. But even if that's the case, from an accounting perspective, that's not relevant. It doesn't, the actual flow of goods in the firm has nothing to do with the choice of accounting method that you make. So that's another kind of question you'll often see on a CPA exam. They'll say, why does this company use FIFO? And one of the answers will be, because it better matches the flow of goods with the actual inventory. And that's always the wrong answer, okay? Because they're trying to get you to say something that has, the accounting choice has nothing to do with the actual flow of goods in the firm. Okay, so what are some of the choices that you have? Now, you might say, why don't all companies just use the same method? And then life would be easier. We as accounting students, or you as accounting students, would only have to learn one thing and everybody would be happy. Well, there's a couple of reasons, but some of them are to try and kind of mimic the actual flow of goods, and some of them are for purely tax benefits or other reasons. Okay, so some of the acceptable methods are first in, first out. And the way you want to think about first in, first out, please cooperate. Okay, so you buy some goods, you sell them. You buy some more goods, you sell them. So the stuff that you buy first is the stuff that you sell first. And you kind of imagine thinking about this as in the grocery store. Do you ever see like the crazy woman, which is me, standing in the refrigerator unit, like I'm putting my whole body into the refrigerator to get the one in the back? Why am I doing that? Okay, what do you mean they're the freshest ones? Because in a grocery store, they want the older stock to get pushed out the door first. So how do they do that? They rotate the stock from the back, right? They restock in the back. So the milk is the oldest in the front and the newest in the back. And I am trying to evade the FIFO, but the reality is the way you want the products to leave your store are the first ones that come in should be the first ones that you sell. So sort of in some sense, that makes a lot, it's logically how things work. Now, in a grocery store, there's a genuine need to make the products go that way, because if you leave them sitting around and they have an expiration date, you can't sell them after a particular date. So it's economically sensible to do that. But realistically, I never finish the milk by either the first dude. I mean, I don't know why I'm reaching into the back of the refrigerator. It's just a bad habit. Okay, another possibility would be last in, first out. Okay, so that would be the case as if instead of stocking from the back, you were stocking from the front. And so people just grab the first one. They're grabbing the one that came in last. Okay, so last in, first out is another possible way that you could imagine goods flowing in to your firm. So let's say you have something that's incredibly heavy. So you bring in some product, and then you get another shipment. Well, instead of like lifting that other stuff up and putting it under, you just stack them all on top. Well, that might make sense, and so therefore the last in might genuinely be the first one's out. Okay? Again, this is just, I'm trying to explain the logic of how the flows work. You don't have to be consistent with your accounting choice and your actual flows. Okay, weighted average would say, well, it doesn't really matter which product we take. We sort of imagine there being some average product, okay, and we just figure out the cost. So we figure out the cost of the average unit throughout the period, and then any product that we take is sold under the presumption that it cost us the average. And then, you know, specific identification is like what you would use for a perpetual method, which is each item has a specific cost, and we match it to there. And then the retail method, which we use as this is sort of an interim method. When we don't actually physically count up our products, we try and say, well, we know how much we sold, okay, and we know what our markup typically is. So we know what our sales are from our cash register. We know that we try to mark up our product by 50%, and so therefore we can infer what the cost of our product must have been, okay? The retail method is not a, yep. Okay, so let's talk about why LIFO is permitted in the U.S., and then you can kind of back out why LIFO is not permitted elsewhere. So LIFO used to not be permitted in the United States until there was a significant amount of inflation, okay? And then when we had high inflation in the 70s, it was, oh, what can we do to kind of provide some tax benefits to companies to, you know, stimulate the economy. And one way of doing that is by allowing the use of LIFO. And what LIFO does is it assumes that the products you bought most recently are the ones that you used, okay, or the ones that you sold. And so therefore your cost of goods sold is higher because you're using the recent costs. And you get tax breaks. Basically, you know, your income is lower, and so your taxes are lower. The reason it's not allowed internationally is for exactly that reason. It's the choice of LIFO is sort of to provide tax incentives, to companies if prices are going up. And internationally, the whole idea behind international standards is we don't have any one government that's setting the rules, right? We're kind of, we have to appeal to all the governments. So in order for everyone to be able to accept and kind of be willing to uphold the standards that we create, we can't artificially put in incentives that some governments may not want to propose. So LIFO is not, so when you ask some companies in the U.S. why or why not are you looking forward to the transition towards international standards, the biggest issue will be, well, we're concerned about the fact that we can't use LIFO, and that may end up costing us a lot in real tax dollars. Okay, so that is one of the big concerns about harmonization. Okay, so as I said, even though I was trying to explain how these methods could conceivably be thought of logically, what you decide to use as a company does not have to be the same as the actual flow of goods. Okay, but here's the catch, and this is probably the only time you ever hear me talk about taxes in this class. And the reason I never talk about taxes in this class is generally there are what in the U.S. is what we call a two-book country. Okay, so you have your tax returns and you have your financial reports. And to create these two sets of reports, here you use IRS rules for tax reports, and for financial reports you use GAAP. And those two things are different. So a company might have lots of income from a GAAP perspective, but because they're going to take every tax advantage available to them, every loophole that's in the system, every affordable, every available tax policy that helps them out, they might end up with no income for their tax returns or pay very little taxes. Okay, so while we're putting our best foot forward to our investors, we want to show how much income we have. But on the other hand, we want to tell the government we have nothing and we're poor and please, don't charge us a lot. Okay, it's sort of like if you are trying to sell yourself to a prospective employer versus sell yourself to a financial aid officer, right? Sort of your interests might be different. You might be telling them different sorts of things about your abilities, about your so that's what we're doing with these two books. But in accounting, the one rule is, with respect to taxes and inventory, is if you choose FIFO for your financial reporting purposes, you must choose FIFO for your tax purposes. And if you choose LIFO for financial reporting purposes, you must, so there has to be a consistency between your accounting choice and your tax choice. And that is not true in almost all other cases. So in all other cases, when I'll say, why do you think the company chose this method or that, if you say, oh, to minimize their taxes, I'll usually say, no, that's wrong. But in the case of inventory, taxes are a relevant determination. You choose your inventory method and know that whatever you choose for your financial purposes is going to affect your real taxes. Okay? Now, should companies care more about their financial reports or about their tax returns? So if I know that I have to use the same policy for both, should I choose the one that makes my income look higher from financial purposes, or the one that makes my income look lower so that my taxes are lower? Which should I care more about? Okay, so you think it just depends on whether I'm public or private? Anyone else? Have anything they want to say about that? You're all really smart, right? And you know that this is how things work. So you're an investor in a company. If you see a company choosing a method that makes them look better for their financial purposes, but technically, this company is the same. It makes the same sales. It sells the same products. It has this is just an accounting fiction. It's a choice. It has nothing to do with any economics. One is, sometimes that's called window dressing. So you can make the company look better, okay, by using FIFO rather than LIFO. So you make the company look, I'm an investor. I see them choosing a method which is artificially making them look better and which I know is actually costing the company real cash flows. Shouldn't I punish that company? Shouldn't investors be smart enough? I mean, we're not expecting investors to be, without any savvy. We're not expecting investors not to do their homework. So why would the public versus private be the relevant issue? Shouldn't investors be smart enough to see through this? You guys are, right? We're gonna, after this class, you'll be ready to go. No, they're not? You're sure about that? Okay, but it doesn't matter if all investors know what they're doing. All you need is some of the investors to know what they're doing. They'll drive the price to the correct value, and then, right. As long as some investors in the market know what's going on, it should be okay, right? No? And can you come up with any reason, anything else besides just public-private distinction? But if you're not-for-profit, usually you are tax-exempt. So that's probably not going to be your issue. Okay, so it's not clear whether or not investors get it. It's not clear whether or not even institutional and sort of sophisticated investors get it. And there has been a fair bit of work trying to look at whether people can see through earnings manipulations that end up having real tax consequences. Unfortunately, there too, the results are sort of mixed. We don't really have a. And if I have time, I'll try and give you kind of a cute story about burning money, which would explain why companies would still prefer, even if everybody understands what they're doing, they would still prefer to pay more taxes. Okay, so let's just talk about the actual mechanics before I get to talk about the fun stuff, which you won't see on a CPA exam. Okay, so let's say the bookstore is making the following purchases of a textbook. Okay, so the faculty member is not that diligent and doesn't put in the order on time, so that they don't actually order all the books at once. They kind of order the books in little dribbly amounts. Okay, so at the beginning of the semester or on the first day of the year, they order 100 copies of the book, and the book costs the bookstore $80. Okay, that's not what they're going to charge you, obviously. They're going to mark that up, but that's how much it costs the bookstore. Then, of course, 2 weeks later, they call and say, well, we need another 100 copies, but now these are some crazy price increases, but let's just stick with it anyway, okay? Just go with it. Okay, so let's say the price is increased to $90 a unit. Okay? What has happened is, well, maybe there's some scarcity and they can afford to charge the bookstore more, or maybe they just, I don't know, whatever. So they charge them more for the next 100. Then they still need some more books. The stragglers who haven't really bought their books yet are still more coming in saying, yeah, we need more books. So they buy another 100 copies, and yet the price has now been jacked up again, $10 a unit. Okay, bear with me. I mean, these are kind of ridiculous, but this could happen. Let's say it was only 10 cents, okay? And then another 2 weeks later, they buy another 100 copies. Okay. Now, why does it matter that the prices have changed? Let's say between the 1st and the end of February, the bookstore sells all 400 books. Then we don't really care, okay? Because this is how we know exactly what our cost of goods sold is. It's all the books that we bought. But what happens if the bookstore only sells 300 of the books? Which books should we say that it sold? Should we say that they sold the expensive books? If they sold the expensive books, then their cost of goods sold is high. What does that mean? It means their income is low. If their income is low, what does that mean? Their taxes are low. They still sell 300 books, whether they choose LIFO or FIFO. So remember, it doesn't matter which method you choose. They had to buy the same books and they had to sell the same books. So there's no economic difference in a firm that's chosen LIFO versus FIFO. The only difference starts coming into play when it's real taxes. So one company is going to actually shell out more taxes, and one company wouldn't, depending on which they choose. So let's say they chose to sell the cheap books. Okay? Well, what will happen? The cost of goods sold is going to be lower. What will happen? Well, they'll pay higher taxes, but when they present their financial information, they'll still have higher income because the tax rate isn't 100%. So overall, they will look better from a purely income perspective, but they'll also have given the government more cash, and which is more valuable. And economists would tell you the cash flows. It's all about the cash flows. And over time, companies should not be able to mislead their investors with just earnings reports. And what actual people who work in the market will tell you is it doesn't work like that. People are fooled, and therefore it is in your best interest to actually present the best foot forward in terms of income. Okay, yeah. IASB. So yeah, so if the U.S. completely adopts IASB, one of the points of contention before we're kind of completely harmonized would be deciding whether or not you can use LIFO. And right now the answer would be no. I mean, if we just adopt it as is, LIFO would be off the table, and that's why a lot of the companies are arguing against adoption or asking for at least some exception to IASB for LIFO. Okay, so let's think about the textbook example here. What was the average cost? So here's the books that they bought. Over this, I forgot the clicker thing, so just say it out loud. Okay, so if you think about the whole period, what was the average cost of a book over the period? Okay, so you bought 100 units at each of these, so it's going to be right in there, $95 a book, right? Okay. What is the price of the first set of books that you purchased? Okay, 80. So when you think about first in, first out, if you were to sell just 100 books, you would be selling the ones that, you wouldn't literally be selling the ones that cost $80, but you would be selling, from an accounting perspective, the ones that cost you $80. How about what's the price of the last book's purchase? Okay, so it's not even on there. 110. Okay, so if 110, if this is the cost of the last set of books purchased, and you only sold 100 books, then of course your cost of goods sold would be based on a price per unit of $110 per book. What's happening to prices? Okay, so everything I'm going to tell you about LIFO and the way it works and how it saves you tax money depends on two things. It depends on prices actually going up. Okay, if prices don't go up, then LIFO doesn't work the way I'm suggesting it does. Because last in, first out means the most recent stuff is the stuff that you sell from a cost of goods sold perspective. And the presumption is that prices go up over time. Is that always true? Do prices always go up? What are some industries in which that's less true? Okay, so prices are, probably over time, decade-wise they go up, but maybe not so much on a month-to-month basis, yeah? Okay, so anything that's kind of a highly fluctuating price, but you would have to agree that prices of oil are a lot higher today than they were 25 years ago. Maybe not from one month to the next, but sort of in a broad sense over time. So ExxonMobil is complaining about the inability to use, like they're one of the companies, because from that, even though there is a lot of fluctuation, it's just over a long period of time, prices could change a lot. Yeah. Okay, so anything where there's a technological change or shift, okay, so think about it. If you wanted to buy an iPhone 3, now all of a sudden you can buy it for 99 cents, right? Why is that the case? Well, it's because the demand for a certain product has gone down, right? So any company that's stocking the iPhone 3 isn't going to be willing to pay a whole lot for it at this point, given they can't sell it for very much, okay? Same thing with technological advancements in terms of like TVs or things like that, right? So it used to, if you wanted a big screen TV, they were pretty expensive. They figured out how to make them. They're a lot cheaper now. It's not only that you, the customer, are getting those cost savings, so are the companies, right? The actual cost of manufacturing the product has gone down, and that's why the cost to you, the company, has gone, or the consumer has gone down. Okay, so it has to be the case that prices are going up for any of this to kind of work out. All right, so let's say this is what the company does. Okay, it sells. So there are a bunch of people who are very diligent, and they show up at the bookstore before the semester starts, and they buy their textbook. And then a couple, then the semester's about to start, a couple more people buy it, they flow in, and then the students who are sort of towards the end, they say, okay, fine. And by the 4th of February, if you haven't bought your textbook, you're probably not going to buy one at that point. Okay. Can the bookstore charge you more like yesterday than they charge you today for the book? I mean, do they? Probably not, right? I mean, they could, right? Anybody could, but you're kind of mad, right? If you show up one day, I mean, you don't usually mind if you show up and there's a sale, but the people who bought it at the higher price certainly mind. But you certainly wouldn't expect the bookstore just to jack up the prices when the cost, just because it's farther into the semester. So usually there might be like one price per unit, and let's just say they're charging everyone who walks in the door $200 for the book. It doesn't matter what the books cost them. The list price on the back of the book says $200, and that's the price you have to pay. So let's talk about this. On 110, what are they recording? Okay, what is this company recording when it sells 50 units? So you come into the bookstore, 50 different people, I type it into the register. What is their journal entry going to look like? Okay, let's say you have to pay for it. So whether you pay credit card or cash, that's the same thing. So let's say you get some cash. How much cash am I getting? Okay, so $10,000, and now what about the cost of goods sold? Do I do anything at this point? So assuming I'm using a periodic system, I don't do anything. Okay, I don't say, oh, well, let me figure out which ones were last relative to this date. I'm going to figure out which ones were last relative to the entire accounting period. Okay, so I don't do anything at this point. This is the only entry I make. Same thing for the next. So here, these are all going to be exactly the same, just, this one's going to have a slightly different amount, right? This one's going to be cash, 20,000, and sales revenue, 20,000. And other than that, that's all we do until we're ready to close our books. Okay, so now we're going to close our books. Now is when the interesting things come into play. Let's say we use LIFO, FIFO, and weighted average, and I want to determine my cost of goods sold, my ending inventory, and my net income, assuming I have a tax rate of $40,000. So let's just going back here, we have 100, 200, 300. Okay, how much is our total revenue for this period? 60,000. Does it matter whether we've chosen FIFO, LIFO, weighted average, any other technique? No. Customers come in, they give us $200 a book, we sell 300 books, that's it. That's what we get in revenue. So no matter what method I'm using, so for all methods, my income statement is going to start with sales of $60,000. Now, should it matter which method, let's say I haven't decided which accounting choice to make yet. People came in, they bought the books. I don't know which books they bought. All books look the same to me, right? Once they're on my shelves, they don't expire. They're all the same edition. I don't know which ones I don't even care which ones I bought first, right? So let's say I haven't done a very good job kind of figuring out exactly which book went out where. Why does the LIFO, FIFO weighted average choice matter? Because it's going to affect what I put here as my line item for cost of goods sold. So let's think about it this way. Let's start with LIFO. How do I figure out what my cost of goods sold is? How many units did I sell? Which units did I sell if I assume the company uses LIFO? Last in is the first out. So go back to this slide here. This assumes that the last ones in are the first ones I sold. So if on this, when I sold these 50, which ones are my accounting books telling me that I sold? The ones that cost 110. Okay, so first I have 50 units. Hello, come on, please look. Okay, 50 times 110. Then I sell these. Which ones did I sell? Again, last in, first out. So what are the last ones in relative to this sale? I still have another 50 at 110. Remember, because I bought, maybe this is a better slide for you to see, okay? So here, after the first purchase, I had 50 left. Now I have 0. Okay, so I sold another 50 that cost 110. How about the next 100 that I sold? Which ones did I sell? The ones that cost me 100. Okay, so 100 at 100. And then I sell another 100 units over time, 50 and 50. Which ones did I sell? Okay, well, at first I sell 50 of the 90, and then I sell another 50 of the 90. Okay, so, whoops. So I sell 50 times 90, 50 times 90. This is how I'm computing my cost of goods sold, right? Now, this is not really how I would compute my cost of goods sold. It's just this is a very simple problem, and we can do it this way. How am I really computing my cost of goods sold? Well, how many units do I have left? Okay, I bought 300. I bought 400 units. I sold 300 units. How many units do I have left? 100. So if I have 100 units left, and I use last in, first out, I know first these were sold, first then these were sold, then these were sold. So what do I actually have as my ending inventory? Of the units I have left, which ones do I have left? I have the first ones, okay? I have 100 units. At 80. Okay? So, now just confirm that whether we go forwards or backwards, you would get the same answer. So what is my cost of goods sold if I compute it this way? I have basically an average, I mean, I can do it in my head by sort of a little bit logically. 300 books, which on average cost me $100 each, so this is going to come up with a $30,000 cost of goods sold. right? Now, here, what is my ending inventory? So, if I go and I say, well, my beginning inventory, so my inventory was originally, I purchased 8,000, and then I purchased another 9,000, and then I purchased 10,000, and then 11,000. And now I'm telling you, I have 8,000 left. What must my cost of goods sold be? In order for me to get from 38 to 8. Okay, so these are the same. This is how it works. So what you do is you kind of compute what is in your ending inventory. Okay, my ending inventory is 8,000. Why is that my ending inventory? Because I start from the beginning and I say, well, if I have this many units, I start with the first units I purchased because those are still there. Okay, and I figure out what I still have. I compare it to what I had over the period, and I back out my cost of goods sold. Alternatively, because this is such a simple problem, we could just identify which ones were sold. They're not literally the ones that were sold. Obviously, it can't possibly be the case because I'm telling you I made a sale on 110, and I'm pretending the ones that I sold are the ones that I bought in February. So that's just not logically feasible. Yeah. Right? Okay. Okay. So let's say there were 120 left. Which ones did I buy first? The $80. So they're still here. Then what did I do? So I only have 100 of the $80 units. So if I have 20 left, where did the other 20 come from? The second purchase I made. So I'm not suggesting that you do anything with this information, but sometimes some people will refer to LIFO, and then they'll use this other term. Fish. Don't use fish. It makes you sound like kind of not very accounting-y. But it means first in, still here, right? Which is also the same as LIFO, right? Last in is first out. First in is still here. So the ones that I bought at the beginning are the ones that are still here. Okay? I just start from the earliest purchases, and the ones that are still in my inventory are the ones that I have. Okay? Now, so if I were to continue on with this problem, okay, I'm saying my cost of goods sold is $30,000, and my net income is what? Oops. So my net income is $18,000, right? Yes? So tax rate is 40%. Okay? So this is a company which is reporting on its financial statements net income of $18,000. It is paying real taxes of $12,000 to the government. Now, let's say all of the facts of this company are exactly the same as the ones I just presented to you, but instead the company were to use FIFO. Would you be happy if that company reported higher income? Higher income is good? Okay, so the manager might be happy because higher income means I get a higher bonus. Now, you would hope a compensation committee that was made up of smart people would take into consideration the kind of accounting practices that we use and hold you to a higher standard, right? If you're going to use FIFO, then you have to make higher earnings than if you're going to use LIFO. But if there aren't enough smart people around, then maybe you could trick them. Okay, so let's try and do this. So hold in your head, okay? So under LIFO, we had net income of 18 and real tax cash flows of minus 12. Okay, that's what we actually had to pay. All right, so now let's try and do this under FIFO. So first in is the first out. So the units that I sell first come from the units that I purchased first, and so on and so forth. Okay, so if I go back to my inventory account, I bought 100 units at 80, 100 units at 90, 100 units at 100, and 100 units at 110. So 8,000, 9,000, 10,000, 11,000. So now I'm thinking I sold 50, 50, 100, 50, 50, right? That was my pattern of sales. So if I sold 50 books, which books did I sell? I sold the ones that were first in. Okay, so the first ones out are the first ones that were in. Okay, so the first ones out were these 50 books, and they came from the $80 books. So 50 times 80. Then I sold another 50 books. So now I only have 4,000 here and 50. So my next 50 books, where are they coming from? Well, no, I still have 50 left, right? I only used, so I started with 100 of the $80 books. I sold 50, so I have 50 left. And now I sell another 50 books. Which ones do those come from? First one's in, so the $80 books, okay? So now I don't have any left of the $80 books, okay? How about the next 100 books that I sell? Where are they coming from? The $90 books. Okay, well, 0. Okay, so I sold 100 that cost 90, and then I sell another 50 and then another 50. Which books are those? Okay, the $100 books. Okay, how else could I think about this problem? Well, I had inventory. I had 100 units of each of these things. Okay, 8,000, 9,000, 10,000, 11,000. And now I'm telling you I have 400 units that I could have sold the whole period, and I only sold 300 of them. So if the first ones are the first out, which ones are still here? Right? So this would be called lish from the ish kind of, right? So the last ones are still here. So we've got these books sitting here. We have 100 books. So what must my cost of goods sold have been? These are the same. So I'm just trying to help you understand why you don't have to do it this forward, why working backwards makes perfect sense. Okay, even though it's not as intuitive as working forward, the way you do it is you count up, you figure out what you have left, and then anything that's not there is your cost of goods sold. But logically, you'll get the same answer. Yeah. Yeah. That's exactly how you'd want to do it. Okay, now, what would my sales revenue be for this company? Right, nothing has changed. I sold books. How much did they cost me? They cost me $27,000. How much did I sell them for? Did it matter whether I used FIFO or LIFO? No, you guys all came in and paid $200 a book. Sorry. So doesn't matter how much it costs the bookstore, you paid 60 grand. The only difference is now I'm pretending that I sold the first ones in rather than the last ones in. Okay, but as I told you, I don't know which ones I actually sold. Right? I just have a bunch of 100 books still sitting on my shelf, and I don't know which ones they are. Okay, so my cost of goods sold is $27,000. So what is my income before taxes? What is my income tax? What do? I take 40% of this. So what's that? 13.2, right? So I have to pay. What is my net income? So look at how much better I am if I'm a company that uses FIFO. If I was a company that used LIFO, I only had $18,000 in income. But because I use FIFO, I actually am so much more successful. I have $19,800 in income. Somebody tell me why that's just bogus and not very logical. Okay, let's just talk about the firm. How many books does it have? How many books does it have left? 100 books. If they use FIFO or LIFO, does it have the same books left that it had? Same exact set of books. Doesn't matter. Do they earn the same amount of, do they make the same sales to everybody? Is the company any different if it chooses FIFO or LIFO before taxes? No, it's the same company. Now you take the same company and one of them has to shell out an extra $1,200 to the government. So they actually have $1,200 less cash in their bank. Who's the better company? Wouldn't you rather own the LIFO company? They actually have more money. If now we decide we're going to liquidate the firm and we're going to just pay back all of our shareholders, which company would you rather be holding stock in? The idiots that paid the government too much money or the LIFO firm? I would rather own the LIFO firm. Okay, here's the problem though. What if the company's not going to liquidate? And now investors are thinking, which company should I buy? And they only look at income. Now, as a shareholder, I can sell my stock for more if I have high income. You know, I have the FIFO company, they're willing to pay more for it. Well, then I, of course, would like my managers to use FIFO. So kind of logically and economically, people who sort of are sensible thinkers would say LIFO is the better firm, or in this case, obviously, because prices are going up. But if the market doesn't see through that and doesn't understand the implications, then it might not be the case. Okay, so let's do weighted average and take a look. Yep. Okay, good. That's actually really important. Okay, so the answer is you have to make the decision at some point, and you can't change back and forth. You can change your inventory method maybe once, but you can't keep changing it every year depending on how you feel. So it is a one-time change if you change, and you can usually change. Usually what's going to happen is you change from FIFO to LIFO. It's actually really painful to go the other way. And so some of the evidence that we have is that companies don't get penalized that much when they change to LIFO because everybody kind of understands, oh, we're making a big change, therefore our earnings are going to be lower than they have been in the past. But you have to make the decision kind of up front, and you can't change back and forth. Okay, so you can't say, oh, in this period, prices are going up, therefore I'm going to use LIFO. Next year, they're going down. And this is, you know, in some sense, you've made a case for why LIFO isn't so great. LIFO relies on the fact that prices are increasing. If it's not a sure thing that prices will always be increasing, then LIFO doesn't always help you. It doesn't always lead to lower income and also lower taxes. Because if prices were to first go up and then go down, it's anybody's guess which actually results in the bigger tax burden. Okay, so if you were ever asked, why do you think this company didn't choose LIFO, you could say, well, it's not clear that prices are consistently increasing, and therefore it is not actually an advantage to that company to be on LIFO. Okay, the other thing you need for LIFO to work out the way I'm describing is also inventory. You can't drop your inventory levels. So let's suppose you have some really old stuff in your inventory, okay, based, not literally old, but old prices. Then if you use up all of your inventory, okay, the last in, first out, okay, only leads to those expensive prices if you don't use the early cheap stuff. So let's say we used LIFO or FIFO and we had sold all 400 books, it wouldn't have made a difference, right? And if we had some books from the previous year, it's not clear whether it would have been better to have used LIFO or FIFO. Yeah. Well, so in some sense, if you don't have a lot of inventory, okay, and you don't build up your inventory, then you don't have to worry about dipping into early layers. You still do benefit, though, from having LIFO. It's just that you're probably not going to have that reversal if you're not building your inventory. So usually what happens is a company makes up its mind and it stays put. If it decides to change at some point, it needs to discuss it with its auditor, and that would be a reason for the auditor to have a qualification in their opinion. They would actually have to highlight the fact this company has changed its accounting method. Now, are you allowed to? Absolutely. It's a permitted method switch. When would a company do that? Well, first of all, what you could do is you could just start a new type of inventory and use that method so you don't have to use the same method for all of your inventory. So you can, so you'll see companies where they have like some of our, like they'll say 80% of our inventory is on FIFO and the other 20% is on LIFO. Now it's not always the case that that's within firm decision. It could be the result of two companies that merged. One used to use LIFO, one used to, you want to sort of figure out why. But you can choose different inventory valuation methods for different types of inventory. You don't have to stick with the same one for all your inventory. And you could argue, well, some of our inventory is obviously increasing and others, but you can't switch back. You have to sort of stay the course for each inventory class. Okay, so let's do the weighted average. Now, weighted average is kind of a high, it's a combination of the costs of both the early period and the later period, right? You're basically averaging the costs throughout the entire period. So let's say we have the same situation. We have 100 units at 80, 100 at 90. Whoops, that's too many zeros. So now, what was the average cost, you already told me this, from the company's perspective, of each unit that they had to purchase? 95, right? So yes, some of the books cost 80, some of the books cost 110, but on average, if I just said all the books were approximately the same, they all cost 95, I would have spent the same amount as if I bought them in this sequence, okay? So I'm trying to sort of say, well, it doesn't, because all the books are equivalent from my perspective, I shouldn't really suggest that I bought some books first or other books. You know, they're all the same book. Let's assign to all of them the same cost. Okay? So effectively, I'm telling you, I'm going to end the year with 100 books. Each had an average cost of 95, because I don't know which books I'm ending up with. So I'm just going to assume each book is an average book, and I have the average number. Okay, so if I end up with 9,500 in my ending inventory, what must my cost of goods sold be? Okay, so what is another way of thinking about that problem? How many books did I sell? How much did each book cost me? Okay, those two numbers are going to be the same. What is my income statement going to look like? Well, I have sales revenue, same amount, cost of goods sold, and where is this falling relative to LIFO and FIFO? Right in between. Now that's because prices consistently went up, so it's literally in the middle, but it might be more closer to LIFO or closer to FIFO if I didn't buy equal amounts or if the prices didn't go up as smoothly or something like that. Okay, what is my tax burden under this? Okay, so what is my net income? So my net income is $18,900. My taxes are minus $12,600. So which method do you like best? You just like it. Or you think it makes it? Okay, so companies will use weighted average. It's fairly common. It seems really easy now. The problem is it's less easy when you then now have to buy more books, so then I have to take a new average, right? So it's not like it's always going to be a $95 average. That's true. Yeah. Well, sort of, yes and no, because it depends on what happens to prices, right? Okay. Any other feelings about this? Yep. Yes. The idea is you have to be systematic and consistent. Okay, you can't just be flip-flopping to make your taxes less or more in any given period. And the same for your accounting. You have to kind of stick with one. Otherwise, you are allowed to switch, but it comes at a cost. Any other thoughts? Why one might be more preferable, less? Yeah. No. So you will basically read an income or a set of financial statements, and the company will tell you, here's the method we use. And now, I gave you kind of the vanilla version, which is not really how it's applied in real. Like, this is sort of the most simple way you could think about it. But it's intuitively, I mean, it's kind of the right idea. Ultimately, this is a hard thing to do in practice, the way we've done it, because usually you report quarterly. And you need to kind of come up with a cost of goods sold at the end of the quarter. And if you use LIFO, what is last in from your perspective is the stuff you bought most recently. But technically, at the year end, the stuff that's the last in is, so you would have to kind of, your 3 quarters would not sum up to your final. So usually if you're a LIFO company, your interim quarterly reports aren't actually using LIFO. Okay, they're using some kind of retail method or some other method just to kind of get around the fact that we don't really know what if I sell something January 1st, technically LIFO would say I should use the products I purchased in December. But the problem is in March when I'm making those financial statements, I don't know what the prices are in December. So I can't really anticipate what the last ones in are, and I have to basically come up with a forecast. Okay, so now what would happen if the following year I were to go, so right now we're standing in the end of, let's say, the end of February with my inventory, and I have 100 units left. Now, if I used FIFO, I had 100 units that were the expensive units. If I use LIFO, I had 100 units that were the cheap units. Now, let's say I buy more inventory. How does that affect? So I'm going to now make some sales for the next semester. So I'm going to buy some inventory in July and August, and I'm going to make some more sales in August and September. Okay, what is that going to do? Well, nothing. Okay, from the accounting perspective, these are the first ones in your inventory, and these are the first ones in your inventory. So anything you buy afterwards, if you're using FIFO, you're going to use the $11,000 worth of books, or the $110 books first. And if you're using FIFO, okay, you're going to use the new books first. I'm sorry, if you're using LIFO, you're going to use the new books that you purchased first, and only dip into those old books if you sell more than you buy. Okay, so you just start your inventory as this is whatever you have left is the oldest stuff that you bought. And then depending on which method you use. Now, if you were to use weighted average, right now I have 100 books at $95 a book. So anything I buy, I need to compute for the next period a new average cost per book, which takes 100 times 95 and however many times whatever the new price is, average that, weight it, take the weighted average, and then that's my new cost per unit. Okay? Now, so let's imagine that this example, let's say we only do this once a year, so we only buy the books in January, February. So now we're in the next January and February. And I buy, because I know I'm pretty successful, so I'm just going to buy 300 books all at once up front. And the books cost me $120 each. Right? They've gone up, again, still going up from the previous year. Okay? So I buy 300 more books at $120 each. Okay? Now, if I only sell 300 books, then everything still kind of works out as I would have expected. Okay, because the cost of goods sold is going to be lower for which firm? Right, so why is my cost of goods sold? So let's say I bought 300 books. I now have 400 books, and I'm selling 300. Which ones am I selling? I mean, not literally, but what am I pretending I'm selling? Well, first, I'm going to sell 100 of these, and then I'm going to sell 200 of those. So the books that I bought last year are cheaper than the books that I bought this year, so my cost of goods sold is lower. If I use LIFO, which 300 books do I sell? Well, I just sell the most recent ones. The last ones in are the first ones out. Okay, but what happens if I sell 400 books? All 400. What happens then? It doesn't matter which one I choose. So what is my cost of goods sold under FIFO? What is my cost of goods sold? Okay. And what is my cost of goods sold under LIFO? Is that what you would expect? Is that what you would expect? What usually happens under LIFO? Usually under LIFO, your cost of goods sold is higher. Here it's not. Why not? Well, it's not that I don't have backup inventory. It's that I used inventory that was cheap because it's old. It's really old. How old is it? It's the stuff that I bought absolutely first. And that was the $80 stuff. So this is what's called a LIFO liquidation. And this is where you have to pay attention. So if you ever look for a company and all of a sudden they had been doing kind of badly, and then they have more income than you would expect. Okay, you want to check to see if they perhaps had a LIFO liquidation, because one way of effectively increasing your earnings is by saying, well, you know what, we're just not going to buy that much this year. That allows us, because we're a LIFO firm, it allows us to dip into these really old, cheap layers. The costs are very low. Yeah, okay, we'll take a tax hit this year, but at least we can jack up our income so that, you know, people stop bothering us. That's an artificial way to basically boost your income. You're basically timing your purchases and liquidating the layers so that your income appears higher this year. Now, if you're getting out of your if you decide I'm not going to be in this space anymore and I want to liquidate my inventory, you know, it's unavoidable if you're using LIFO. But it's always a red flag when you see a company liquidating, when you see a LIFO liquidation, because in that period they're much more likely to have higher income than you would have expected had they used either FIFO or any other method, which is kind of the flip from what's normally the case with LIFO. Okay, so this is just sort of a little mini example of how a liquidation can work. Okay, so yeah, if you want to, that's okay. The last thing that we're going to talk about today is dollar value LIFO, and this is trying to get you a little bit away from the sort of super simple LIFO that we talked about so far and moving in the direction of the kind of LIFO that companies actually apply. Okay? So one of the drawbacks of the LIFO that we used so far is you needed to keep track of both each individual unit, how many you bought, and how much each price was. Now, you didn't need to know which units you sold, which was easier than, say, specific identification or perpetual method. But you did need to keep track of both quantities and prices, and you had to remember how many each layer had in terms of quantities rather than just dollars. And what lots of companies will do instead, and plus, we talked about the problem that could happen if you liquidate a layer. So what companies try to do instead is they actually use something called dollar value LIFO, which says, we don't really worry too much about the number of units. We try and value our inventory as a pool, okay? And each layer has a value, okay? And then we compare how much it would cost us to buy our inventory right now with how much, it hypothetically cost us. And any difference is due to a change in the quantity, right? So think about it this way. Let's say I have 100 units and it costs me $10 each, and then at the end I have 100 units and they cost me $12 each, okay? The reason my inventory value has gone up, or the cost of my inventory has gone up, is because the price went up, and only because the price went up. On the other hand, if I had 100 units at $10 and 8 units at $15, then it would be because I genuinely sold some product. And dollar value LIFO is trying to take into consideration whether the changes in the inventory levels come from just changes in prices or also come from changes in quantity. Changes in quantity would indicate an actual sale. Changes in prices just reflect, inflation or some other changes. Okay? So let's talk about what you do. And this is a little tricky. So we'll talk about it a little bit today, and we'll probably talk about it a little bit more after the review session and then the exam. I will not expect you to know dollar value LIFO for the midterm. That doesn't mean you should get up and walk out right now, because you will need to know dollar value LIFO eventually. But this, I just want you to know, because we only have a fairly short amount of time to talk about it, that I won't test you on this. But it will be part of your homework, so you should pay attention. Okay, so let's say I start my company in 2005, okay? And I have inventory at the end of 2005 that is worth, not worth like in the sales sense, but if I had to buy this inventory right now, it would cost me $100,000. Now, we're going to say 2005 is what we call the base year, the year in which we start and against which we compare all future prices. Okay? Now, the price index is therefore basically just 1, or this is 100%. Now, if prices go up by 10%, okay, and I'm trying to measure what my inventory would be worth if prices were 10% higher, how much would it be worth in the next year? So let's just say prices have gone up by 10%. I'm measuring my inventory, okay, and I say it now would cost me $110,000 for that inventory. Do I have more or less inventory than I had last year? Same. Why do you think I have the same? Because last year it cost 100. This year that same exact inventory costs 110 only because prices went up. So if you look at my inventory and you say, did I sell anything? If I started the year and I ended the year and I hadn't made any purchases, you would say, no, you haven't sold anything. Just because the price of your inventory went up, that has nothing to do with your cost of goods sold. Okay? And that's kind of the way you want to think about price indices. They're basically converting, okay, they're a mechanism for converting current costs into old costs. So how do I do it? Well, I just take the value of my inventory right now, I divide it by the price index, okay, and that'll tell me what it would have cost in base level prices. So in this example, every year my inventory is staying exactly the same in terms of quantity. It's fluctuating all over the place in terms of dollar cost, but I'm not actually, it shouldn't really affect my cost of goods sold, because really all that's happening is the price of the ending inventory is changing. Okay? How about in this case? In this case, prices are going up, right, in the same exact pattern that they went last, and then they're going back down. But the value of my inventory at the end of the year is 100 in the first year and 100 in the second year. What can you tell me about the level or the amount, the quantity? Did I sell stuff or did I buy stuff from 2005 to 2006? So if I wanted to figure out how much this amount of inventory would have cost me in 2005, what would I do? I'd divide by, so how much would that inventory have cost me in 2005? Or put it said differently, if I had $100,000 of inventory in 2005, and I had to buy that same exact inventory again in 2006, would I have more or less inventory? I mean, how much would it cost me in 2006? Sorry. It would cost 110, right? So in order for me to have the same quantity of inventory, I would need to have at least 110. Do I have 110? No, I have less, right? I have 100 divided by 110. So what happened to my inventory? I have less. I have a lower quantity than I had in the previous year. So what dollar value LIFO is trying to do is it's trying to say, I'm not just looking at the value of my inventory somehow. I'm trying to figure out, given the value of my inventory, is it changing because price levels are changing? So just the cost, it costs more to do business this year than it did last year, or is it changing because quantities are changing? And in the first case, right, last example, it was changing only because price levels were changing. And in this case, it's changed. In the next case, it's changing because quantity levels are changing. Okay, so I can infer that I must have sold a certain number of goods, because if I still had the same units on hand here as I have here, then I should have 110 in my inventory, but I don't. I only have 100. So therefore, I must have sold some product. Okay, this is kind of the basic idea, and we're going to then after the break, or after Tuesday we'll have a review session, then Thursday we'll have an exam, and then we'll sort of talk about the details of how you get dollar value LIFO, how you actually do the computations, and that'll be part of Chapter 8 and Chapter 9. But you don't have to know this for the midterm, okay? So I'll see you guys on Tuesday.